Nigeria has been experiencing a trend of month-on-month increases in inflation, with annual inflation rising to its highest level in 2 decades at 26.72%. September's figure was the ninth straight monthly increase. Food inflation, which makes up the bulk of Nigeria's inflation basket, rose to 30.64% in September from 29.34% in August. Now, while we await the figures for October, with yet another increase expected, we're already getting some predictions that inflation in Africa's largest economy could hit 30% by the end of the year. Fadekemi Abiru, head of insights for Stears, which provides data-driven intelligence on Africa, joins me now. Fadekemi, welcome to Business Edge. Thank you so much for joining me.
Glad to be here, Tolu. Thanks for having me.
So while we can't ignore the trend we're seeing when it comes to Nigeria's inflation data, for September, we're at 26.72%. Not so far away from the 30% prediction. So what are the key drivers of inflation we're seeing right now that Steers thinks will drive Nigeria to that 30% by December?
So the latest figures from the MBS are a clear indicator of escalating inflationary pressures within our economy. As you said earlier, the rise to 26.72% in September from 25.8% in August paints a stark picture of the escalating costs that consumers and businesses are contending with. Now, when we break down these figures, we notice that the inflationary pressures are predominantly propelled by soaring food prices, which recorded a staggering 30.6% increase. This is contrasted with the core inflation rate, which excludes volatile items like food, and that stands at 21.85%. When we scrutinize the monthly changes, we start to see a nuanced dynamic emerging. So the month-on-month inflation rate for September actually slowed to 2.1%. So that's down from the previous month. What we're seeing is that this deceleration is largely attributed to a reduction in the monthly increase of food prices. So that's likely influenced by the arrival of the main harvest season. And this seasonal influence is a vital factor in tempering food inflation from its recent peaks. Looking forward, while we expect the harvest season to kind of exert a calming effect on food prices in the fourth quarter, the annual inflation rate is anticipated to remain elevated. So our projections suggest that barring significant disruptions in supply chains or spikes in energy costs, we might approach but not necessarily breach the 30% threshold in the remaining months of 2023.
Okay. So you talked about painting a picture, and I want us to do that again now. In terms of the data that we have available, how much of it tells us that this inflation is attributable to internal factors such as government policies, currency devaluation, versus external factors, global economic conditions, international trade? We all keep watching to see what the Federal Reserve is going to do. We all know how the Russia-Ukraine crisis has continued to have such an impact on food and global supply chain. So how much of the inflation that Nigeria has been experiencing in recent times is more internal versus external, more external versus internal, or we're seeing them both have almost a balancing influence on the situation?
Yeah. So, there are many factors that influence inflation in an economy like Nigeria. So, for example, what we've seen in the data is that there is a sizable influence of exchange rates on inflation, given that a lot of key sectors in the country rely on imported inputs for production. So that ends up being reflected in the final cost of goods and services. According to the Stears FX Monitor, so that's one of our intelligence solutions where we track how currency movements happen across different key currencies on the African continent. The Naira has shed 37% of its value since the start of this year. And while we have seen some appreciation in the currency over the past few days, we'll need sizable dollar inflows into the Nigerian economy to really ease the pressure on the Naira at the moment. And that would also have that knock-on effect on the inflation rates that we're seeing through the pass-through effect. But outside of the exchange rates, there are other key factors. So from petrol prices as well, which feed into the cost of transportation, and even policies that would, and even policies that would be focused on improving productivity in the country, those matter as well to understanding the key drivers of inflation in Nigeria.
So I don't want this to just be a data conversation, because at the end of the day, at the end of the figures, we have people, we have everyday Nigerians who are trying to make the Naira go as far as it can. I would have even said Naira and Kobo, but right now, Kobos don't count for anything in the grand scheme of things. So what is the impact we're seeing of this rising inflation, particularly on Nigerians, in terms of purchasing power, cost of living, even the standard of living across the nation? There's the conversation around the urban inflation versus rural inflation. Take us through that and this picture of what it really looks like for most Nigerians right now.
Yeah, that's a very good question. I think imagine it this way. If last year a basket of goods cost 100 naira, this year that same basket would cost almost 127 naira. So that's a big jump from the previous month. And the data suggests it's mostly because the price of food has gone up a lot. And this is important because food makes up the largest proportion of the average Nigerian's consumer basket. So what we end up seeing is a shrinking wallet size for many Nigerians, particularly those on low to middle incomes. And that actually makes up a huge proportion of Nigeria's population. So in fact, it's very likely that we would end up seeing a hollowing out of the middle class as inflation erodes purchasing power and could even push more Nigerians into the lower income brackets. So what will end up happening is that we'll see Nigerians becoming more focused on balancing their budget, so they'll want to switch to cheaper alternatives and also reduce their basket sizes as they become even more price sensitive.
So now looking at the wider economic implications of inflation, we know what it looks like for individuals, but in terms of the GDP growth, unemployment rates, even more importantly, and even investment trends, there are small businesses that are closing up and having to return people to the employment market, but there are not enough jobs. Fadekemi, what is that looking like when we look at GDP, our growth rate, when we look at employment or unemployment as it may be, and even investment trends for the kind of clients you work with?
Yeah. So, I mean, inflation typically has this like dual-edged influence on GDP. So, on the one hand, it might initially drive nominal GDP. It might drive it higher due to increased consumer spending in anticipation of higher future prices. However, in Nigeria's case, what we've seen is persistently high inflation. So we've been in this double-digit inflation rate numbers for the past 8 years. And so this actually has the impact of suppressing consumer spending and also investment as the real value of money diminishes. So as a result, if inflation is not tempered, it can actually lead to a slowdown in real GDP growth. So for Nigeria, the critical question is whether the inflation rate exceeds GDP growth rates, which could imply a decrease in the real economic output. And that could potentially even signal an inflationary recession scenario. When we talk about unemployment, that is usually historically depicted by the Phillips curve. So economists tend to talk about it like an inverse relationship between the two. But in the context of stagflation, so when you have your GDP numbers in single to low digits numbers like we're seeing in Nigeria, but then also high inflation, that would then become a more complex situation. So for Nigeria, structural issues such as a mismatch in the labor market skills, so that's when the available skills don't necessarily match up with the jobs that there are vacancies for, and even infrastructural deficits as well could exacerbate the unemployment situation as inflation persists. And also, when businesses face rising costs, it could curtail like their intentions to expand, and they'll become even more hesitant to hire. So that could potentially even like compound an increase in unemployment rates as well. If we're also thinking about investment, high inflation basically creates an environment of uncertainty, and that can reduce the real returns on investment and even make long-term planning challenging. So investors are typically seeking to hedge against inflation will find themselves diverting their funds to assets that are considered to be inflation protected, right? So that's why with the Fed increasing interest rates, the US is historically seen as a safer economy to invest in. And so also when we see like rising geopolitical tensions in different parts of the world, like the Middle East and so on, that essentially means that investors will be flocking to other parts of the world that are deemed more safe, because there are even positive real returns over there when you're kind of seeing negative real returns in economies like Nigeria.
All right, so let's look at something else we found in September. So the exchange rate premium, that's the differential between official and parallel rates, rose to 25.2%, which is a significant increase from what it was in August. Now, the expectation is that it will keep widening and exerting further inflationary pressure unless we see significant dollar inflows into the economy. We've heard this is going to be about $10 billion that we should be expecting in the next few weeks. But as of this morning, from late last night, we're also hearing that the CBN has started clearing the FX backlog, including to foreign airlines whose funds were trapped in Nigeria. So in terms of just that change in the past few hours, and we've even seen the Naira react favorably to this again, what impact could this have, if any, on this 30% inflation prediction that you have? Again, you had said earlier that it doesn't necessarily mean we'll hit 30%, but we likely will be scraping it and touching it. But seeing this FX backlog cleared, seeing the Naira reflect and the market to react positively in the past few hours to what's been happening with the CBN and the backlog clearance, how does that affect your prediction, if any?
Yeah, that's a very good question. And we have heard about the FX backlog clearing activities, and that is a welcome development, given that, the dollar liquidity issues that Nigeria has been facing has made it very, very hard for, businesses. I think, you've even seen some businesses or investors pausing operations in the Nigerian economy. Emirates Airlines is just one example. To name a few, but it's still unclear where the dollar inflows that are used to support these clearing activities is coming from, and that matters because it's important that these dollar inflows are sizable, and then they're also going to be consistent enough to sustain the clearing of the $10 billion backlog that the CBN is currently facing, and even future economic activities to come.
Okay. I want to go back to something. That's this inflation calculation. We know we need this data to accurately make economic decisions and plan for the future. But one thing that's been consistent is many people don't believe that the data that comes out, even from the National Bureau of Statistics, is actually really reflective of the macroeconomic realities and even the macroeconomic realities that Nigerians face. When we talk about 30% inflation, what does that really mean in real terms, in the real economy? As you said earlier, if I was buying something for 100 Naira last year, I'm probably buying it at 127 Naira this year. So really, in terms of the calculations and how we're effectively calculating, are we getting to the real numbers to be able to allow us to make the truly needed economic decisions and to plan even economically for the real economy and Nigerians?
Yeah, so to answer your first question around what 30% inflation would really mean for the average Nigerian, I think the most immediate and palpable impact would be on purchasing power. So with inflation at 30%, the Naira that an average Nigerian spends on goods and services would decline sharply in value. So simply put, what 1,000 Naira could buy today would cost 1,300 Naira in the near future. So that's assuming that salary levels do not adjust upwards at the same rate, and they hardly ever do. So this erosion of purchasing power hits the most vulnerable the hardest, as they spend a larger proportion of their income on basic necessities. And also, just touching on something you said earlier about, this mismatch between the inflation numbers that people see and then also, what the inflation numbers that get reported and then what people are actually feeling in the economy. I think one big thing there is just, when you think about how inflation is calculated, it's actually computed by, weighing, aggregating data on a basket of goods and then seeing how those prices change from one period to the next. So it's very, very important that that basket of goods is representative of what the average Nigerian spends their money on. And that's something that needs to be updated. So when you look at the MBS's basket of goods, you kind of see like a lot of goods in there don't necessarily represent the average Nigerian's spending bracket. There have been a lot of innovation since that initial basket was devised. Things like, airtime, data, spending on apps, etc. Those are the different kinds of things that also matter for the average Nigerian's consumer baskets. And so those things need to be reflected in the CPI calculations so that they become even more reflective of what the average Nigerian experiences in terms of prices.
Okay. So we know there's a changing landscape out there, particularly economically for Nigeria. We've seen it, especially with the federal government's determination to stabilize the forex market. But Fadekemi, in terms of the variables, what are they? What should be considered for strategic and investment plans for 2024? I know with the data-driven intelligence that Stears does, the clients are looking to you to provide this information. What are we considering? What are the variables on the table right now as you have clients coming to you looking at Nigeria and looking across the continent for the next year?
Yeah. So investors should definitely continue to closely monitor the CBN's policies regarding FX, including the level of interventions that are put in to stabilize the naira, as that is a key indicator of whether there is enough supply to match the demand for FX required to do business in Nigeria. Monetary policy announcements around interest rates, the asymmetric corridor, they are also key because while monetary policy transmission might be weak in Nigeria, there's still a strong signal, or there could be a strong signal as to whether the CBN is committed to price stabilization, which is its main mandate. And also, one thing that people also need to realize is that monetary policy alone is not the only tool available to fight inflation in Nigeria. So even though for a long time, a lot of focus has been on monetary policy side of things. So Nigeria's inflationary challenges have long been characterized by cost push factors. So if we wanted to understand this better, you could look at the agriculture sector. So that employs over 50% of Nigeria's workforce, but it contributes only around 26% to GDP. Given the latest numbers that came out. And this discrepancy points to a fundamental inefficiency that we're putting too many inputs and those are yielding too few outputs. And this kind of situation is just it just signals, broader productivity issues within our economy. So just to put this into perspective, Nigeria's GDP per capita stands at about $2,000 roughly, and that has grown at a modest rate of approximately 1% since 1990. In contrast, we've seen countries like China and India experiencing GDP per capita growth rates of about 5, 8% respectively over the same period. So essentially, we want to see a lot of policies that are focused on growing the pie, so creating a more resilient and dynamic economy that will be capable of withstanding inflationary pressures. So investments in infrastructure, the tech ecosystem, etc., those are also really strong signals to watch out for.
All right. So before I wrap this up with you, I want to expand a little bit because you also launched the Pan-African Inflation Forecast. Nigeria's forecast came first, and Kenya is coming shortly, sometime in November as well. And then you'll have forecasts for other African countries in early 2024. But Fadekemi, can you give us just an idea of what we're looking at when it comes to how things, particularly inflation, is going to play out across the continent? While we all face the same external factors, internal differences will leave room for different projections. So what do we think about, or what are you guys giving us in terms of projections and predictions for inflation across some of the major economies on the continent?
Yeah, so that's correct. In fact, the global spotlight has definitely been on inflation. Since the second quarter of last year, the IMF has consistently flagged inflation. So, I mean, there are all sorts of reasons for that. Rising global energy and food costs that have also been intensified by geopolitical tensions. The pandemic seems like, a far gone memory, but, we're still living in the aftermath of that. And that has pushed inflation to historic levels. So if we're even moving outside of Nigeria, we've seen countries like Kenya that started out this year with inflation rates as high as 9%. I know it pales in comparison to Nigeria's inflation rate, but it does fall outside of the CBK. So that's Kenya's central bank's upper limit of 7.5%. And since then, we have, actually seen the impact of the base effect, like tapering out inflation in Kenya. So last year was particularly a high inflation period for the Kenyan economy because, the impact of rising import prices like wheat on the Kenyan economy actually led to like record inflation rates over there as well. But inflation rates have now like even been brought back down to the CBK's target. But even the latest numbers for October suggest upward pressures are mounting again. So I think the reading was at about 6.9%, and that puts I think that's a 3-month high for Kenya right now. And it's very likely that, rising PMS prices, I know like the Kenyan government has put in a stabilization fund to kind of mute the effect of rising petrol prices. But, we are expecting to see even further pressures there through there are global projections estimating that oil prices could even hit like $150, and that could actually end up, adding even more pressure on the cost of petrol that Kenyans are paying. There's also the depreciating shilling as well. That's also been exerting inflationary pressures over there. And then the impact of El Nino. So, weather impacts are also affecting harvests, and that cannot be discounted. So, when we are seeing varying levels of the pace of rising prices across the board, but the upward pressures remain the same.
All right, so finally, before I let you go, Fadekemi, you've just mentioned it. We're all feeling the brunt of some very fast-paced monetary policy changes, particularly from the developed economies. America breathes and the rest of us catch a cold. And we've seen their interest rate hike from 0.25% in January 2022 to 5.5% in September 2023. But we know that yesterday, or this week as it is, the Fed decided to hold. So many people are thinking, okay, we're coming to the end of this hiking or this hike rate cycle that we have the Fed going through. But what we've also seen is that increasing the monetary policy rates, as we've seen across many African countries, has not necessarily given them the impact of dousing the inflation tame. So right now we're all looking back to the US. So with the US Federal Reserve's decision to hold on interest rates, do we expect to see some kind of cooling effect on African economies' inflation? Or is it just really at this point not going to go by those typical economic equations that many people have been expecting?
Yeah, I think as long as the real returns that investors can get in the US remain positive and at like a good enough level, while real returns in countries like Nigeria are negative, then it's very likely that pressures on African exchange rates will struggle to ease up, and that would also impact like what we're seeing on the inflation side of things. I think that really the real thing that African countries will want to address is tackling their productivity challenges, because that would really ease up the inflationary pressures that we're seeing across the continent.
All right, Fadekemi Abiru, Head of Insights for Stears. Thank you so much for joining me, and I'm very sure we'll be having you back soon.
Thank you for having me. Bye.
Fantastic.